Hello, everybody, and thank you for coming in to another episode of the 0%. Right now, we're going to talk about the application for certificate of discharge of property from a federal tax lien. So let's get into it. In this one, we're going to talk about real estate. All right. Now, property here, when it says discharge of property, it doesn't necessarily mean that it only pertains to real estate. It can be against you. It can be against the business. It can be against machinery. It can be against vehicles. And that's all considered property. So when it comes to real estate, I'm going to show you how we attack that and we can get it removed quickly. I mean, this is something that us as investors, when we take over property, maybe as a subject to, or we actually buy it through other creative financing, which I'll explain here. This form, it doesn't matter. This form is what we use. It doesn't matter if the property has a federal tax lien on it. It doesn't scare us not one bit. We use this all the time to get rid of federal tax liens on property. This is information that I wanted to share much earlier with you all, but of course, the members, you weren't ready for the information. And now that you have a lot of these checklists checked off, you have these items checked off in your process of putting your trust together and understanding land trusts, irrevocable versus revocable, living, spendthrift, and all of that. Now we can talk about these things because we're ready to apply. So like I said, this is just for real property. This is Form 14135, application for certificate of discharge of property from a federal tax lien. Okay. For example, I have a potential client. This is what they have going on here. Mr. and Mrs. Montalto, right? They've got taxes that are it's up there. It's $175,309.81. It's up there. So it looks like we have 3 tax years going back: 2020, 2021, 2022. It has the amounts for each one of those. These are high-end earners to have a tax bill of that caliber. So this is a federal tax lien that is against their person, and if not paid, this will be attached to any property that is in their name. The goal here is to get all of that out of your name so that way they can put you on that list that we talked about in the other video, non-collectible. You're on the non-collectible list. We can't find you. We can't find where any of your property is. We have no interest in coming after your assets. And that's the whole point. So let's work on this as an example. And let's say this federal tax lien is being attached to their house, $175,000. Okay. So going back to this form here, how we would fill this out. Number 1, box 1, who is the taxpayer? We would list both their names down there. Actually, it would just be one, and then there's another form for the wife. So one for the husband and one for the wife. They would put the last 4 digits of their social, and if they have a business EIN, they would list that as well. The address that's on the tax lien, so that way it matches. Now, who is the applicant? I'm just going to tell you this is being submitted. Let's say I'm the one who's going to buy their house. So this is submitted by me, the buyer. But in all actuality, the person who's going to be the applicant for them is the trustee who purchased the property. Okay. So for you to really understand what I'm talking about, let me pull up my notes here and we'll look at it from this aspect. Okay. So the objective goal, we need to cancel the equity. See, the equity is why they would place this $175,000 lien on their property. They're coming after the equity if the property is ever sold. That's called proceeds. They would take it from the proceeds and apply it to the debt. So we need to cancel that equity by engaging a wraparound mortgage. That's what they call it if you're in a mortgage state, or an all-inclusive trust deed, AITD, if you're in states like California or Nevada. That's we're going to put that together for the reduction of the national public debt. So that phrase there needs to be listed within your AITD or wraparound mortgage. So let's say they're home in Lake Mary, Florida. They have an outstanding loan balance with Morgan Stanley for $700,000. And the after repair value is $845,000. So clearly we have a $145,000 equity sitting in this property. The tax lien is $175,000. So the IRS, their goal is when there is a sale, and a lot of times taxpayers are inclined to sell if they don't have any other means of paying this balance off. They're inclined to sell. Now this process is going to remove it from the property, but like I said in the other videos, we have the other forms like 433. We would send that in every year to let them know, look, I'm uncollectible. Leave me alone as long as I am a wage earner working with an employer. Once I become employed or as I operate as a business owner, then we really don't have to worry about this too much, because at that point, our businesses are owned by the foreign express trust. The IRS will see that off the bat, putting that entity on the zero file list, and there's really nothing more that we have to worry about. Just make sure that anything we buy, it is titled in the name of the trust and not our personal in legas name. So if that process was to take place, that sale would sell for $845,000 minus the $700,000 loan. We have $145,000 left over sitting on the table at escrow. Minus, let's say, average 4.5 closing cost, that's $38,000. They have $106,000 left over, and that will be paid to the IRS with a balance of $68,334.84 that they still owe. Who knows when it's going to be collectible, but if that stays there if it goes over 10 years, it's non-collectible. They have a 10-year limit to collect. All right, keep that in mind, 10 years to collect, according to the IRM. Now we have an alternative. What can we do? We can use creative investing, seller financing, okay? By using that and an irrevocable express trust, we can avoid all of that, all of what we just said above. Step one, Mr. and Mrs. Montalto, that's the seller. They sell their property to an irrevocable express trust, which is the buyer. They use an LLC as the trustee. The trustee, of course, is already 8832 approved, right? But even if it's not approved, I'm still moving forward. I'm just going to make sure that application is submitted and in process. That LLC is created out of Delaware, Wyoming, New Mexico, or even maybe Nevada. Why those states? For owner and manager privacy. In those states, well, I know, for example, in New Mexico, I could list the name of my registered agent as the manager, and I could list the registered agent's address everywhere. And the Secretary of State will accept it. So if you want to find out anything about my LLC, however you were able to connect the dots, you must contact the registered agent. Take it a step forward. If you did it in Delaware, you can't get a hold of that real estate agent or registered agent unless you get a court order to pull all that information and make the registered agent give it to you. So that's why Delaware is the best one that everybody uses. Now, this LLC is owned by their foreign trustee, a non-resident alien by contract. The beneficiary is a private business trust enterprise, which has a bank account opened by the LLC owner. Okay, so step 2. The current equity is $145,000 minus the capital gains and closing costs, right? So instead of keeping and using and acknowledging the $145,000 equity, because how did we get that? That came from fractional reserve banking. That's how that happened. In all actuality, if this same property was on the market in the 40s, it'd only be about $2,000, $7,000, right? You have like $40 a month payment. That's what my grandmother did when she bought her house in Los Angeles. She bought that house for $9,000, $38 per month, and sold it in 2007 for $600,000 and moved over to Georgia. So where did all that come from? That's just fractional reserve banking from everybody doing exactly what the Federal Reserve, doing exactly what the Federal Reserve wants them to do. There's a way around that, but we all have to come together to do it if we want to reduce the national public debt. So we want to get rid of that $145,000. We have to cancel it. The only way we cancel it is to sell the property to the trust for only $10,000 equity. And you do that by selling it to the trust for $710,000, just $10,000 more than what is owed to Morgan Stanley. So we have $710,000 plus, give or take, 2.3 Florida buyers closing costs. That's $16,000, but that can be offset with the WA bin, right? The trust is the buyer. Under treaty laws, it will offset those fees, so it doesn't have to pay the county. But let's just say it didn't do that. Well, Mr. and Mrs. Monalto will deposit that, let's say $17,000 into that trust bank account and go ahead and pay it. It's still theirs. It's still theirs. They control the entity, okay? So it's not like they're losing $16,000. You take that 710 minus the 700,000 that's owed to Morgan Stanley, and there's $10,000 equity that will be deposited or made out to the trust, with nothing left over from the sale to carry over to the United States. So therefore, there is no value in the interest of the United States, and the title has already been transferred over to another person. So they can't further go after this piece of property. Okay, you need to do a wraparound mortgage or an all-inclusive deed of trust. That means when we sold the property for $710,000 to the trust, that then became second to, let's see, what's the word we want to use? That became a junior lien to the first lien, which is the 700. So the buyer would pay on that 710, and then the seller would use the proceeds from that to pay off the 700. Okay, that's how that would work. This is paper. That's all it is. It's paper. So let's go back to our form here. So again, we list the taxpayer information. Now the purchaser, that's the trust. We put the trustee in number 2 as the applicant, relationship to the taxpayer, right? Relationship is a buyer. The purchaser, that's the name of the trust. That's the new owner. Relationship to the taxpayer, beneficial owner. There is no attorney. Okay. There is no lender or finance company here. So if we were under the rules of section 6325B3, then we would put this here. But as you see, when we go down to that section, you'll see it doesn't matter. Number 6, what is the monetary information? What did we sell the house for? $710,000, right? Expected proceeds to be paid to the United States in exchange for the certificate of discharge. We have to put NA. There's nothing left over to go to the United States. Number 7, what is the basis for the discharge? So that, like I said, if we were a lender, we would have to go under B3, which says proceeds from property sale held in escrow is subject to the liens and claims of the United States. So that does not apply. What does apply to our situation is 6325, subsection B, subsection 2, subsection capital B. The interest, the federal tax lien of the United States in the property to be discharged has no value. Why? Because there's nothing left over. And a wraparound mortgage or an AITD is a legitimate, it is a legitimate financial instrument. Excuse me. Okay. Number 8, description of property. That would be the legal description. Address of property. You put the address. Now, check this out. You see this in parentheses? Look how sneaky the IRS is. If this is personal property, list the address where the property is located. What do you think I'm thinking of when I talk about personal property? Birth certificate. That is a title. Is this an opportunity for us to list that $9 billion lien? And guess what? The $9 billion lien can never be satisfied. Therefore, no proceeds of a sale. So there's another way to do this to remove taxes off of your person. I've given you the 433-F, which you do every year, but what about this? Maybe this could be done once. So maybe you want to listen and see all of this information first before you decide, what do I want to dibble and dabble with? Okay. So you would put the address. So if this was my birth certificate that I'm talking about, and you know, I have a tax lien they're coming after me. I don't have any properties for them to attach anything to, nothing. They're just trying to find a way to put me in federal prison for not paying. Then the address of where that birth certificate is held. I'll leave that to you to figure out what address you have to use. But in this example for real estate, so it says for real estate, there's a difference. Real estate, and there's a difference for real property. And there's also the term in property real. Look that up. So a legible copy of the deed or title showing the legal description is required. You would hit that, make it attached. For discharge requests under B1, copy of the deed, title for property remaining subject to federal tax lien is required. So you'll check that off, okay? A copy of it. Also give a copy of the actual tax lien that they're talking about. Appraisal, that does not apply, not doing any of that. Plus one of the following additional valuations, county valuation of property, real property. You can just pull out your recent tax statement on the property. That'll show you the current valuation that they've deemed it to be. If you have a third party that did that for you for valuation, you can include it, but otherwise we leave that alone. Proposed selling price for the property being sold at auction, we don't have that. And there is nothing else for the other. So just your tax bill right here, and that will show your county valuation. All right. And applications under section 63B1, we don't need that. A copy of the federal tax lien, list that number, all the information from there, hit attach. Copy of the sales contract or purchase agreement, hit attach. That is your AITD or mortgage, wraparound mortgage. Title report, attach that to show that there's only 2 liens on the property, which is Morgan Stanley and now the trust. And how do you show a real lien with the trust? Well, the trust will file its UCC1 in the county. And this time they would have to select off that box, mortgage home or manufactured home transaction for that $10,000 equity. HUD statement, the closing statement. Remember, you're actually going to use a real estate attorney or a closing agent, an escrow company, to do this for you. So they will give you all of those receipts to show that you really sold the house to this trust. All right, as the buyer. Additional information that may have a bearing on this request, such as a pending litigation, hit no. Escrow agreement, hit no. Waivers, if you are applying as an owner of the property and you are not the taxpayer, to have this application considered under section that, you must waive the rights that would be available if the application were made under section that. If you choose not to waive these rights, the application will be treated as one made under that, and any payment will be treated like a deposit under that section. Please check the appropriate box. I understand that an application and payment made under that does not provide the judicial remedy available under section that. In making such an application payment, I waive the option to have the payment treated as a deposit under section that, and the right to request a return of funds and to bring an action under that. No. All right, we don't waive anything. So, and you're considered a third party. That's why you have to fill this out. Who's the first party? The IRS. Who's the second party? The taxpayer. And who's the third party? The trustee who's filling out this application. And the trustee is not waiving its rights, so we hit no. And then, of course, the trustee will sign under declaration. Okay? So that is how you submit, and I guarantee you'll get it dismissed like that, quick, within about less than 45 days. Okay? So that is how you fill out the application for a certificate of discharge on real property. You must sell the property, utilize wraparound mortgages, AITD, to sell the property over. And have a real lien to show that it's not going to be sold. The IRS cannot tell you how much to sell your property for. Okay? If you don't dictate the market price, you don't have to accept the market price. Keep that in mind. All right, and then maybe in the future, we'll look at this form to, well, we will, not maybe, we will. We'll look at this form on how to utilize this towards the ins legis and to reflect that $9 billion lien that we've done, that promissory note. All right, thank you all for joining and tuning in. I'll see you in the next video.